Start recording.
Okay, welcome everyone. Thanks for being here. The County Design Project Workshop Series. Thank you, Tai Young, and all those involved for inviting me. My name is Brett Johnson. I'll be the moderator today. And today we have a double header. We have not one, but two excellent papers. And we'll start with Agnes Cheng from Oklahoma for the first 45 minutes. And then the second 45 minutes will be Charlie Wang from Harvard. Just a few reminders. If you haven't participated on one of these before, if you would please mute your volume until you're ready to ask your question, then please come off of mute. If you'd like to use the raise hand feature in Zoom to indicate you'd like to ask a question, or just type your name in the chat and I'll call on you in turn to ask your questions. If you would please allow the speaker the first 5 minutes of their presentation, kind of set the stage for everyone. And then I'll kind of keep everything going as far as the timing for the speaker to have the last few minutes of their time slot as well to wrap up. So with that, Agnes, we'll turn it over to you. Thank you.
Hey, thank you. Can you see my slide? Okay.
Yes, it looks great.
First, thank you so much for inviting me or give me this opportunity to present this paper. Excuse me. As the name implied, and it's quite clear about our research question, we want to report or document if the market actually use the operating less leverage ratio to assess the risk. And let me introduce you my co-authors. Nancy Yadang. She is currently working at Hong Kong Polytechnic University. She's still a PhD student from Harbin Institute of Technology. Xia Zhao, teacher at Auckland University. Her dissertation actually was in this area. And so I also have worked on some papers related to this topic. So we kind of naturally get together to work on this. Okay, so I got 5 minutes to give the essential. Okay, so this is my basic outline. So let me start about the background research question. I think many of you, if you have worked in the operating lease area, you will know what is the essence of the new standard. But still, that I will give a quick introduction. Back in early 2000s, that there's a lot of accounting scandals. You all know about that. They use a lot of off-balance sheet accounting, like off-balance sheet liability, hide the risk. So after the Enron debacle, that people are paying more attention to the off-balance sheet debt. And in 2005, ICC chairman basically saying that estimated the off-balance sheet operating lease estimated about 1.25 trillion for the US. And FASB and IASB then developed a joint project and continue work until, of course, that we have to get a lot of feedback from the companies and from the professions. And many people comment on that. First, all the operating lease, like the future 5 years and later after, already in the footnotes. So why do we need to formally recognize? And people worry about that may increase a lot of risk for the company because they may violate the debt governance, etc. So FSB regulator, of course, gives some time, say, well, you need to kind of adjust it. And eventually that January or February 2016, IASB and FASB issued the standard that effective around end of 2018. Okay, so let's see. What is the main difference? That for the US, the old lease standard that it can refer to FSB 13 or ASC 840. And the main difference between the old one and the new one is that the main change is for operating lease, and it has to be recognized on the balance sheet formally. And However, because of that, if we recognize asset like the capital lease, company have to recognize depreciation and interest expense. In the early years, it's going to be quite high, much higher than the annual operating lease payment. So so US basically allow company, or at least design the standard, so company continue to report the rent expense for OL, do not need to recognize depreciation and interest, but also require a lot more detailed disclosure. So this is just a quick summary. For the old standard, we call capital lease. New standard is changed to the financing lease and or finance lease. And also the classification was moved earlier, not not at the lease inception, rather that when the asset is ready to use. So the disclosure part become more and more stringent. Okay, so now just again, I'd like to point out a bit about the lease classification. That for the US, it matters that if the lease is classified as operating lease or capital lease, because the income statement presentation are still different. And so you can see the new standard take out the bright rule, like 75% or 90%, and also make it be more difficult to categorize lease to be the financing lease. And as you can see, it's a bit more principle-based. Okay. Let's again look at an example. This is an example from Amazon, and you can see that before the adoption, the company report only 27,213 as the other long-term liability, and this other long-term liability actually include the capital lease. And for the year of adoption, and it's broken down to the part belong to the lease liability and also other long-term liability. And so 2019, the liability increased a great deal. So you can see that the total stockholders' equity and liability increased dramatic from 162,648 to 225,248. So we all know, like, accounting reporting, do have consequences, and so this kind of consequences could affect, even though the underlying operation may still be the same originally, but because of the new standard requirement, company may change their decision. So there are quite a few papers actually look at it. This is also showing that the note describe clearly about the total comes from how much comes from operating, how much comes from finance. And also let's look at the footnote. So 1 year before the adoption, we see the note 7 has reported the operating lease for the next 5 years and the later after. And after adoption, that the same thing in terms of this number. However, the new standard require extensive or expanded, more qualitative and quantitative disclosures, including the weighted average discount rate. And we will collect the weighted average discount rate from the report and then estimate, make an estimation. So presumably, those kind of additional disclosure can help the users to make estimation better. Okay, and one thing that we just simply look at the numbers, you can see that the before the adoption, a report 2020 is 3,070, but then after the report 2020 is 3,757. It could be due to the company's additional activity, or could also be due to that they have to reclassify some of their leases. Okay, and so just kind of background to show the estimation that we rely on the estimation from the footnotes, because one of our main purpose is to evaluate how useful the disclosed information. So this is just a review of what we teach students in the media accounting. First, we estimated the effective interest rate, basically use interest expense divided by average total debt. And then we estimate the operating lease liability based on the future 1, 2, 3, 4, 5 years given. And then also we presume thereafter they will continue this 2195 for another 5 years. So we found the present value. So whatever remain in the thereafter, then we calculated a total will be like on average 6 years. So we discount 11 years back. So this is a mechanical estimation, and maybe the user investor may go in detail, maybe use a little bit different estimation method, and that sometimes like for quick estimation, users may simply use the like average operating lease and multiply by 8 or something like that.
So Agnes, Stephen
Yeah.
Pinman has a question.
Okay, yes, please, Steve.
Just a note, Agnes, I found out that for a number of companies I've looked at, for the current operating lease liabilities, they don't list them as operating lease liabilities. They lump them together with other current assets, other current liabilities. Have you seen that too?
Well, that I think what I use as example, they are more detailed. And in terms of the reporting, companies still have discretionary. Yes, I see some firms, I want to try to find out what is the lease but they don't really report lease. You can see that in Amazon previous years, they just lump together. So I think this is maybe related to, they think of the materiality, if it's important to report them, distinctly. Yeah, so, but in terms of what you are saying that they put in the current, that could be some operating lease was still in a year, so they kind of lump together in the current asset. But if we really want to investigate lease investors, we have to look at I guess the notes.
Yeah, I just found it a bit frustrating because usually we see the other current liabilities being operating liabilities rather than financing liabilities, and now some firms are lumping them all together there.
Yeah. So this is an issue that the researcher, we may, like you're frustrated. I'm sure investor using is frustrated. Maybe researcher, we can look into it. Like, how much more information, more detailed classification we will actually need to see if it's important. Okay, thank you. And so we basically wanted to investigate if the leverage ratio has relation to market risk. Well, mainly the assessment.
Sorry to interrupt.
Yes, please.
Young?
Yeah, I think Agnes, I may be jumping a little bit ahead, but I want to go back to the previous estimation formula, because I think that's a good way to actually have this conversation. Is that I think before the slide before, so this is the
this one?
No, the next one. Yeah,
okay.
the valuation. Yeah, so like this is the pre-standard, right? A40. That's as investors, we don't have a precise information because we only have a cash flow up to 5 years, and after 5 years, we kind of like need to go through some ad hoc estimation, and we also don't have a lease specific discount rate, right? So we are going to assume by using all the total debt, etc. So one of the benefit of the new standard is actually asking the firm to actually give us exactly the present value of the future lease payments without actually asking the external users to make those ad hoc and rough estimation. So what's your view on having that more precise information is going to affect equity investors' risks, right? Because usually when we think about information risk is if more precise information usually will reduce risk
Clean.
if we are going to eliminate that information part.
Yeah.
Holding constant the cash flow, right? So you also have the same kind of conjecture that once we have a more detailed recognition rule should reduce the equity risk.
Yeah, this is a actually very important question. That's what we also wanted to document to show that. And we first wanted, which we call the hypothesis one, we first only want to focus on estimation. And then we, hypothesis two, will look at the differences. And, but on the other hand, that we wanted to ask, say, users, like when I teach financial statement analysis, I ask the students that when we talk about earnings management, etc. And then I say, do you think you want to go to the footnote? Even now, you know, managers going to report their operating lease liability. And do you still think you want to go to the footnotes to do your own calculation? And actually the answer is yes, because do we fully trust managers? So we kind of have footnotes to verify. And so I feel like it's kind of empirical to actually see that, you know, and how much that market actually, you know, use the estimated operating lease versus reported operating lease and in their information set. Yeah, so I will report the result a bit later. Okay. I see Joshua has a question.
Great.
Hi, Joshua.
Hello. So the comment I wanted to make about this slide is that you're using the obligations that are reported in the footnote.
Yeah.
Now, that assumes only the leases that are in force at the end of the fiscal year end. It does not include leases that are going to be renewed.
Yeah.
And so the liability that the company may have, if it is a going concern, if it's a growing company, could be better estimated by taking the rent expense, the lease rent expense, and using that in order to forecast the liability on the assumption that you're going to renew the leases in the future.
Yeah, well, that's a very good point, that this one will then lead to another potential exploration, is that is the footnote complete? And of course, from your point, it's not. So maybe the users and the more sophisticated users will look at rental expense and then do another an estimate. And actually, I think that before this standard is issued, I think maybe it's ongoing. There another estimate simply use the rental expense and divide it by some factor, and to get another estimated. And we did not report this. We actually use some kind of simple estimate, just simply use the interest expense times 8. No, excuse me, the rental expense times 8 to make some sort of estimation. And the results are a little bit similar, but in terms of estimation differences, that it's kind of the differences is much higher for the estimated. So we kind of not really using that. And but you mentioned a good point. So I may look at how much that actually provide additional, you know, risk from the market assessment. Thank you. Okay. All right. So let me go on. And so that
Charlie has a question, Agnes. Before
yes,
you go on. Sorry.
I'm sorry. Yeah, Charles. Hi.
Hi there. This is following up on Joshua's question. So some of in the footnote disclosures, sometimes you might see companies disclose that their lease is not yet commenced.
Yeah.
And sometimes those amounts can be quite big. I don't know if those will capture what Joshua has in mind, but in any event, you know, to the extent you're gonna dig deeper into this, those kinds of disclosures might also be relevant.
Yeah, so I think post ASC 842 company are required to disclose those, that like something ongoing. And we didn't investigate on that. And I think what Joshua's suggesting may include some like continuing, but maybe there are new leases. So that will provide even more additional information about potentially new lease. Yeah. Okay. All right. So so the new standard, as I introduced the background earlier, basically disclosure requirements are a lot more. And that means that should help investor estimate the lease obligation. But another thing is kind of like people discuss when the stock option, should be formally recognized, and the formal recognition will raise the investors' awareness and also will reduce information processing cost. So based on that, we developed the two hypotheses that, and then we're going to investigate on that. So basically, we separate our analysis into purely based on estimated. That is, let's assume the investor do not believe what the managers report in the statement, but still use the detailed footnote to make estimation, even post the new standard. And then we'll investigate the differences between reported and estimated, and see how that play out. Okay, so I wanted to mention the literatures. I'm glad Catherine's here, that in 2007 paper, she discussed that the two hypotheses, like efficient market hypothesis, that basically assume regardless the number is in the formal, recognized, or disclosed, that market will pay attention to it. And there's another hypothesis, IRH, incomplete revelation hypothesis. Then this suggests that reported number will be more important than the footnotes. And we have lots of papers that kind of showing that both hypotheses may coexist. And for example, and actually we followed closely Bratton's Sheep's paper, that they use the footnotes to estimate operating lease leverage. And they find out that the estimated operating leverage predict cost of equity capital and cost of debt. So the cost of equity capital, they measure that as the total risk return variability, which is one of the variable we use. And the paper suggests that capital market participants treat recognized informally and disclosed lease amount similarly, but only when the reliability is not an issue. So actually, this is my explanation. I feel like their findings are consistent with efficient market hypothesis when the estimation is reliable, and but consistent with the IRH when the estimation is not reliable. So then there are quite a few current papers, including Charles, who's going to present. So I summarize a bit of his paper. He has changed, has a new version already. So I'm excited to wait to see his presentation. But one paper by Mar and Wang Thomas, that I think Wang is also here today, that they have mainly focused on the real decision after the after the ASC 842 was issued, and no positive effect on firm risk. They found the use beta risk and credit ratings, and of course the period is a little bit different from ours, and then they look at the cutoff point as 2016, and so I'll let Charles summarize his paper. And our paper mainly look at the firm risk assessed by the market. Okay, it's may not be the fundamental risk, but at least we want to see how market use the operating leverage to assess. And the paper, basically by Tom Wang and also by Charles, I think that basically looking at if the risk has increased after the insurance, rather than specifically investigate how the operating leverage ratio affected the risk. And it's also very interesting to look at real effects. Lots of papers document the real effects. And seems like the evidence is pointing that they do decrease their long-term operating lease. And like before the insurance, the operating lease do not have to be formally recognized. And so a lot of companies will try to arrange their lease so they don't have to report long-term operating lease as a liability. But now they don't have that benefit. So I think it's very natural. We find out they don't do this. The use of long-term operating lease will kind of decrease. And short-term, especially like 1 year term, will then increase. They will try to find out those leases that can qualify to be called operating lease. So short-term, so they don't have to report it in the both balance sheet. And okay, so I don't need to go deeper on this, but basically, I think those papers are quite interesting to look at the real effects. Okay, and so hypothesis first one, we are saying that the estimated operating lease leverage has a stronger effect on investor assessment of equity risk after the adoption. And I list the reason one, kind of like Bratton's et al. Paper, that they find less reliable estimation and market place less weight on the operating lease leverage. And so we find kind of similar result. And also that the ASC 842 should increase estimation reliability due to the more expanded disclosure. And of course that because operating lease liability require formal recognition now, and the more people, well, especially those non-sophisticated users, will look at the formally recognized and assess the risk for the company. So our prediction is that we should see a larger coefficient post the new standard. And the hypothesis two then is try to examine what the Ayan was asking. Yes, Ayan, you have a question?
Yeah, I think I will let you finish the hypothesis two and then ask you my question.
Okay. Yeah. So we will say that report OL may reveal more information than estimate OL. So if the estimation is imprecise and like market cannot estimate precisely, and whatever the manager's report is much more precise, then of course we will find out market will use that information. But on the other hand, that investors, especially those cautious investors, they may look at their own information set, which is from the footnote and others, and they may want to rely on their own because of, at least for some firms, they may not truly rely on the manager's report. So we may not find out the positive relation. Ayan, you want to ask now?
Yeah, so I think in addition to the precision or the estimation risk, right, just with or without having precise information, how much risk that faced by the equity investor, I just want to understand what's your definition of an equity risk, right? So there are many different ways. If we use the CAPM model, there can be total volatilities of a firm's underlying cash flow. And then you can decompose that into the co-movement or covariance with the rest of the firms in the market versus the idiosyncratic unique part, right? So I think I'm still struggle with what exactly is the hypothesis, because we have not really defined what specific aspect of the equity risk.
So it's just kind of used for the common usage, like Bratton's et al.'s paper. And by looking at, I think the popular measures are the systematic risk, which is beta, and also the total risk. So basically, we just see that if market, actually when they assess firms' risk, if that assessment is associated with the reported operating leverage, and there may be other kind of risk we can look into. But in terms of prior, that that I do not have a fixed like a prediction about what type of risk the operating lease is related more. Of maybe the type of risk could be, related their operation risk, like operating activity, because lease is an important aspect for that. But I can give her thoughts for other type of equity risk.
So one potentially kind of like beyond total volatility is the market beta, as previously when you talk about leverage, right? So this can be a nonlinear model about the likelihood that equity investors are going to get zero money back, because actually they are omitting. They don't really know a lot more fixed commitment related to the debt contracts based on the previous kind of like omitted or imprecise operating lease regulation.
Yeah, so
Anyway, that could be a
Yeah.
but related to kind of like total volatilities and covariance, that would be your main kind of like equity risks definition and measures. And then you also mentioned there are other papers already documented that firms actually changing their lease arrangement in terms of the durations or type of a lease, etc. So how do you disentangle this estimation or information risk from the underlying cash flow distribution actually also changing?
Yeah. Well, you know that basically a firm has intention to change their real activity, right? And then affect the leverage ratio. Then, so for example, they know the leverage ratio is going a lot high. So they are going to probably invest more rather than borrowing, through the financing lease or operating lease. And so that is the real change on their balance sheet reporting. Okay. And then, so that real change will be captured based on the differences between the leverage change. So maybe the company has decreased the leverage. And then we look at the real activity, like many other papers do, see if the company actually use real activity, decrease the reported or decrease the implied, whatever, the leverage risk. And then what we are doing is try to see that, okay, once the company had made decision and they reported their leverage on the balance sheet formally, and then how does the market assessment is associated with the reported part. So I guess like company has already improved their risk, then the market will vary with whatever the risk change. And, for example, if the company increased risk or decreased risk, if you look at the level of the risk assessment, maybe you'll see a lower. But we are focusing on the relationship between the reported operating leverage. In other words, we're assuming the operating leverage already reflect the risk that that the manager are targeting for. And actually, I think I mentioned Wang's paper, and I think Charles' paper may also look at it. So basically, that people do find that after this new standard and the level of companies' risk increase, at least the variation, the covariation measured by the beta and measured by total, they vary more. And so, but is it due to the reported or estimated operating leverage? We don't know. So I'm focusing on that for this paper. So of course, I will have a post variable to capture, the other reasons and I change the risk.
And then you would expect that reported would be different from the estimated results. That's why
the reported and estimated are different. So we measure the differences. But of course, the estimation, we can use many different methods. So, so our evaluation will be then based on what method we use. And we do find out their differences. So the differences improve the estimated leverage ratios assessment.
I
And,
will let you go into the results because I think today each paper has shorter time. Yeah.
Yeah, I guess I don't know if I have time to go through all of those, but
You have about 10
I
more
think I'll be
minutes.
reminded how much more time I have.
About 10 more minutes.
10 more minutes. Okay, so in that case, maybe I just go quickly. And so this is our sample selections. We get operating lease liability from Capital IQ. Of course, we use financial information provided our other sources. We also collect, especially collect the reported discount rate. And also that we evaluated the complexity of the lease reporting as a conditional analysis. And so we have a final sample 22 to 54. And a lot are deleted from Capital IQ because many of those are the private firms. And so the research model one, we basically designed the pre and post analysis. And so basically we focus on the estimated OL, okay? And so we then, as I mentioned here, the post may capture a lot of others. And like the concurrent papers, we do find out the company's beta and the total return variabilities increase post the standard. And so the hypothesis two, we focus on the only post adoption after firms formally adopt. And then we evaluate the differences between reported and estimated operating leverage, okay? And so this is our estimation. So when we focus on estimated, we assume, because we want to contrast the so-called association or usefulness for the estimated between two periods. So we try to adjust, make the method comparable. So pre the standard, we added the estimated operating leverage. And for the post, we still use estimated operating leverage. So try to make it comparable. Of course, we adjust this estimation by using actual, etc. later on. And so actual risk, we use systematic risk and the total risk, like previous papers. And we also use change variable. And what we look at, we have to identify a period. We actually look at the post, the 10K filing for annual 52 weeks. We also look at 10K filing before and after for short term. And then the post variable, we basically use if the companies are like here, is effective for public business entity after 2018. So that's our post. So we use the actual adoption EOF. We actually find out between 2016 and 2018, there are some early adoption, but very, very small number. And so we find out 2019, there are 86.55% in our sample. And so mostly come from 2019 fiscal year. And we have add all kinds of control variables. I don't need to go through that. And so the summary statistics that actually kind of interesting to see post-adoption, the estimated is actually lower than the actual, at least based on our estimation. And I'm going to skip that. So here is our univariate comparison. And we find out post the adoption and the risk increased. And also we can see operating leverage based on estimated actually decreased, so that it consistent with concurrent papers that operating leverage, operating lease, okay, does kind of decrease after the new standard. So here's just outline of my empirical analysis. You have the paper. If you're interested on the detailed result, you can go through, but I will summarize the empirical result and so help you reading a little bit. So basically, we organize our analysis based on pre-post, which is a longer period, and surrounding 2016. And post-adoption analysis and focus on a smaller sample and 19 and 20. And then we evaluate if the accounting report complexity that does affect the so-called usefulness or association of the differences between the actual and estimated. And then we also re-estimate our operating lease. We use actual reported discount rate. And because this is available, that especially post the analysis, post the standard, we use change analysis. We also use a difference analysis by looking at high versus low operating lease leverage. I think similar to Wang Thomas paper, except we use different years to classify. And also we check our analysis, does it apply to finance lease or only operating lease? Our suggestion would be only operating lease because that is the main change. We also look at the COVID period before and after. We also look at short term surrounding post 2016 and to the time before the adoption. So here's the empirical results. This is our main result. We call the pre-post analysis. And you can find out, even though we do not highlight the post, the so-called this equity risk does increase. And then our main variable is post-adoption and our estimated operating leverage, and that the coefficient is higher. So because we assume that market be more market participant be aware of the operating lease, and also the estimation improve. So
Agnes,
we show that. Yes.
would you like to take one more question? And then after Stephen's question, I think we should go ahead and wrap up if you have any concluding remarks.
Sure. Okay.
Yep. Maybe I should interrupt here, but you know, the betas for all firms can't increase. The average beta is 1. So it's a question what's going on here. If these firms with operating leases, their betas are increasing, some other firms, the betas must be decreasing. So I think you've got to be a bit careful of that. And it may be due to the weighting of the stocks of these firms in the market relative to the weighting in the market portfolio also. So you've got to be a little bit careful there. I'm sorry, you go ahead.
So you're saying they maybe trade off, right?
Well, I'm just saying that the average beta can't increase for all firms, okay? So
right.
The average beta is 1, always.
Yeah. Okay.
Weighted
so
average beta.
Beta risk measure, we can take a deeper look. Okay, thank you. I think I only have 2 minutes. In that case, I will.
Perfect.
I will go. Oops. Let's see here. I will go down to a conclusion then. Okay. So basically, oops. So basically, we call it informatives. So the new standard improved the informatives of estimated operating lease leverage. And so we all know what the value relevance of earnings means. So this we can simply say risk relevance of leverage may not purely reflect the responses. And the standard improved the estimated operating lease leverage as reflected by the higher association between the operating lease leverage and the market risk. And also hypothesis 2 shows that it improves the reported operating lease leverage because of the market risk is highly associated with the differences. And we also look at when the reporting is more complex, and then we do find out that the usefulness of the or relevance of the reported operating lease is higher, and so it's consistent with Catherine's paper that reliability affect the association. And so the conclusion is everybody already know both recognition and disclosure are essential, and we also kind of documented that. And so I guess if the standard setter asks, like, do you think these are useful? Actually, that paper shows that accounting does have consequences, affect the firm's decision. And we actually shows from the market reflection, it does provide some information there. So, okay, I think my time is up. Thank you very much.
Wonderful. Thank you so much, Agnes, for your engaging presentation. We'll go ahead and transition over to Charlie now for his paper. Thank you, everyone who's participated to this point. Again, we'd encourage everyone who can to share their camera. Makes for a nice engagement and participation here. And I'm going to have to drop off right at noon at the conclusion of Charlie's segment. But if anyone would like to stick around, both presenters said they would stick around after the presentation and take any additional questions as well. Okay, Charlie, over to you.
Thanks, Brett. Thank you, Agnes. Okay, this is a paper joint with my colleague, Jonas Hies, and one of our stellar, very advanced first-year students, Albert Cheng. The paper is quite a simple one. We just ask two questions. The first is, what are the properties of variable lease payments, and how do they compare vis-a-vis operating and finance lease payments? And the second is, what are the consequences of keeping these variable leases off balance sheet per the recent the new lease standard? Now, why are we asking this? Why should we care? Under ASC 842, variable leases remain off the balance sheet. And this is a treatment that was based on the assumption that future variable lease payments really can't be estimated reliably, and that they differ substantially in their properties as compared to operating and finance lease payments. Now, I think that sounds quite intuitive to me, but I was surprised to find out that this decision was at least not without some debate or some controversy, because initially the FASB's proposal was, in fact, to recommend recognition of variable lease payments on the balance sheet, but a decision that ultimately it overturned after quite a bit of pushback from financial statement preparers. Okay. In addition, what we see in the data is that variable leases are economically important. On average, variable lease payments constitute about 40% of the average level of operating lease payments. And finally, so far, there hasn't been a systematic analysis of variable lease payments properties and the consequences of treating them off balance sheet. And so this is where we hope to be able to enter to inform standard setters and financial statement users. Okay. What are variable leases? They're leases in which payments depend on the usage of the lease assets or something like revenues generated by the lease assets. Retailers are one examples of this. They often might lease stores where the lease payments depend on revenues generated at a particular location. Airlines are another salient example. They often lease airport facilities like gates where the lease payments could depend on the level of the airline's operations or the airport's operations. Under ASC 842, variable lease payments that are not tied to predictable economic drivers like LIBOR interest rates or CPI, they remain off the balance sheet. If a lease includes a fixed payment and a variable payment, only the fixed part is recognized on the balance sheet. Okay, but firms who have variable lease payments have to disclose them in the footnotes, and this is what they might typically look like. There's qualitative disclosures about what they are. In this case, which is American Airlines, they talk about the various airport facilities that are under variable lease contracts. And as you can see in the separate disclosures, variable lease costs are significant and consistently significant in each year as a percentage of the total net lease costs. Now, in the initial exposure draft in 2010, the FASB proposed recognizing variable leases on the balance sheet using a probability-weighted approach. And the main argument for recognition was that the view that these contingent rentals met the definition of a liability, and that lessors and lessees typically have some level of understanding about the likely amounts of payments that they could be in principle fixed. What that means is effectively that, like operating and finance leases, present values of future variable lease payments could be estimated reliably. But ultimately, they decided against it. And the main reason, this was after quite a bit of pushback from preparers, who argue that it's in fact quite difficult to predict these future variable lease payments and thus estimate their present value reliably. Okay, and this was the main argument against recognition, and that drove the decision in the new lease standard. So that leads us to our first research question, which is to understand what are the properties of variable lease payments and whether or not they're in fact significantly different from those of operating and finance leases. In particular, we're going to look at whether or not they are in fact more sensitive to revenues, whether or not they're in fact harder to predict and more variable. To conduct this analysis, we compiled I think quite a comprehensive data set and a clean data set of Russell 3000 firms' disclosed period lease expenses. We began by trying to use the XBRL API, but that only got us so far because, as I think many of you in the audience probably know, certainly better than us before we tried this exercise, that the tags were all over the place. So what we ended up having to do eventually was a 2-month manual data collection effort, but we implemented quite a lot of data quality checks. And so at the end of the day, we think we have quite a comprehensive and clean data set. Our final sample has about 3,000 companies. Yeah, Ayo, what's up?
So I just have a kind of maybe unrelated question, but related to the XBRL experience. So like you're probably aware of, there's a holy touch measure to simply counting the number of tags related to some accounting keywords. So what's your experience using XBRL, and how does that really translate into more counts will be more complex reporting?
So, for example, even in a disclosure like this, where things look, we could sometimes observe companies that report in this tabular format very similarly, but the tags, sometimes they might say variable lease cost, sometimes they'll say variable lease expense, and then sometimes the variable lease component, they'll break out the components. So you never see the kind of overall aggregate. All you get are the sub items.
Okay.
And so that introduced a lot of complexity for us, which, I'm sure there are more clever ways to do this. CalcBench is one of these companies that, at least for a while, part of their value add was to create kind of a standardized dictionary to help facilitate this kind of API calls that can help you more systematically obtain exactly the same information. They might have something like this, although last time I talked to them, I don't think they had built something like this yet for this particular table. Brett, you're about to tell me how I could have done this better.
No, I have an unrelated question. Just before you get into the data and the details, I want to ask more of a question related to the FASB process. I think the FASB is very interested in knowing not only how things went for the implementation of this particular standard, but what we can learn as their standard setting process goes forward. And it seems like there's always, frequently, there's a challenge between, does an item meet the definition? You go back to the concept statements and so on, should it be recognized, versus it's just really hard to measure, right? You think about R&D or advertising, sometimes we just take the default to we're just going to expense it or whatever. And so I just wanted your general thoughts on what implications, if any, this paper would have for the standard setting process in general.
Yeah, that's really interesting. And we have been thinking about this. We were actually a little bit surprised when we read the exposure draft, which kind of expressed this view that, seems to meet the definition. And the question is, is the measurement really reliable? But in talking to some colleagues, I think there's certainly no shortage of some sentiment out there that, some questions about whether or not the definition really is met, because you could ask whether or not variable leases constitute a present obligation. So I think mostly what our paper aims to address is the measurement piece. So we're going to take for granted this view that, yes, we can, it meets the definition, but we're not sure about the reliability of measurement. And then essentially, we're going to try and test the assumption that underlies the decision. Okay. All right, so we have about 3,000 unique companies. Not surprisingly, the vast majority of the sample adopted the new standard for the first time in fiscal 19 and 20. There's a very small handful that voluntarily adopted early. And then a small handful that adopted late. These are emerging growth companies. And about 10% of the companies voluntarily provided pre-2019 lease expense disclosures under the new lease standard. Okay. Now, once we have this data, what can we say about their economic significance? In general, what we can say is that they're significant. On average, firms report about $29 million of variable lease expenses, which is about 40% of the average level operating lease expenses in a period. And it's greater than the average amount of finance lease expense in a period. Moreover, what we see is that more than 40% of the firms in our sample in the post-adoption period report variable lease payments. In fact, in 2021, that's 51%. This is among companies with operating leases. And in those cases, variable lease payments constitute about a quarter of operating lease expenses. Okay, so we can conclude that they're economically important. Now, having established that, now we proceed to understand what are their properties and do they differ significantly from those of operating and finance leases. The first one, property we examine, is to check whether or not variable leases are in fact more variable. We're going to operationalize that idea by testing whether or not variable lease expenses are more sensitive to revenues. Ayong?
Yeah, so Charles, your previous graph, did you have data to kind of decompose the variable lease payments into those linked with indices or interest rates versus those kind of more based on idiosyncratic from specific future events?
Yeah, so we don't in this graph, but just to be clear, those kinds of variable leases, the only components that would show up as a variable lease expense would be the incremental expenses when the CPI or the LIBOR interest rate changes from one period to another. We don't have visibility into those components here, unfortunately.
Oh, okay.
But as we were doing our kind of manual data collection, we tried as much as possible to collect whatever qualitative disclosures companies provided about the nature of those variable leases. And based on our notes, the CPI and LIBOR type of contracts are relatively rare, actually, or we didn't see a ton of those. So my guess would be, assuming that whatever they do exist, they're reported. My guess is that they're not a big chunk of what we're capturing here.
Okay, thanks.
But if they are a big deal, I suppose over the last 6 months, they're driving a bunch of changes in variable.
Well, I think one way to validate it is that just regress your variable lease expense with CPI and some of those indices.
Yep, you can. Yeah, for sure. That's a good idea. So that's a good idea. We took revenues as kind of a catch-all economic driver. And I think part of what Yong is questioning is to what extent that's really that captures all the economic drivers that could underlie variable lease payments. And that's, I think, a fair point. Okay. So what do we find? In fact, it's not surprising that what we find is that variable lease expenses are more sensitive to revenues. Okay. I think we're happy to find this result, but one observation here is that the magnitudes of the elasticity is quite small. So if you take just column 1, what this tells us is that a 1% increase in revenue corresponds to a 0.17% increase in variable lease expenses. I certainly was surprised by this, but curious to get others' reactions. Now, the next property that we examine is to see whether or not variable lease expenses are less persistent than operating and finance lease expenses. And to operationalize this test, what we do is to estimate a cross-sectional regression using this period's lease expense on last periods. And what these results show is that the persistence parameters across the 3 lease expense categories are in fact quite similar. In fact, they're statistically indistinguishable from each other. And this was a surprise to us. And the conclusions remain whether we control or don't control for firm level attributes like assets, leverage ROA. We also tried Wang, who's here, gave us some very helpful comments. We had performed some extra analyses based on Wang's comments to check out what happens if we don't log lease expenses or if we scale lease expenses by assets to account for size effects. And none of these alternatives provide different inferences. Okay. So they're just as persistent. What about predictability? We try to examine for kind of within firm predictability of each lease expense type and compare across variable operating and finance leases. And to operationalize this, what we do is to compute the mean square errors that result from a naive random walk forecast. In other words, for each of the expense types, we're going to forecast next year's lease expense based on current year's lease expense. Okay, we're going to compute the MSE. We're going to compare across MSEs. What do we find? Well, when we look at the comparison between variable and operating leases, we do not find that variable leases are less predictable. Okay, if they were less predictable, what we'd expect to see is that columns 1 and 4 and columns 2 and 5 would have big positive coefficients with many stars on it. Okay, that's not what we find. In fact, the comparison between variable and operating leases suggests that they're just about equally predictable. Hey, Ollie.
Hey, Charlie, thanks for a nice presentation. Just a comment here. Have you looked at what happens because like in the tables you showed, kind of the number of observations are always a bit different for like the different types of leases.
Yeah.
One thing that just like a technical question. So I guess like the concern that I have there is a little bit that you have just different firms, right? So that different firms are using different types of leases, and to some extent that could kind of drive these differences in results. So I was just wondering like how these results look when you always hold the sample constant, or even if you want to go further, if you kind of try to compare firms more by trying to really like get like some matching going here when you really have like a firm that has a variable lease relative to another firm.
No, that's a fantastic question. My co-author Jonas is here. Jonas, do you recall? I know we had talked about this. I don't know if we actually have checked.
I think we haven't checked it, but it's a fair point. We should.
Yeah. This suggestion that Ollie's making really applies to kind of the comparison between the columns 1 and 2 versus columns 4 and 5. And the main sample difference arises because there's far fewer firms that report finance lease expenses. I think most of our paper, frankly, is really mostly about comparing variable leases to operating leases. And so in that sense, I think this is maybe why wasn't a very urgent task on our list, but certainly we agree that it's something we should check out. Ayong?
Yeah, I think this is just a random thought. Have you thought about like just control for the persistence of a revenue? So potentially exposed that all those variable lease payments are very persistent, but that I think there's a self-selection that maybe very steady revenue stream firms are more likely to up for.
Fantastic.
Yep. Yeah, right. And then either way would be okay, but like it just kind of like exposed. You cannot really judge them based on exposed realizations when ex ante that they actually self-select.
Yes.
Awesome. Into this contract. Yeah.
Yeah. So Ollie raises a really interesting point, which is different kinds of firms might select into different kinds of lease types. Yeah. And to the extent that you might, certain companies might figure out how to variabilize leases, it could be those firms for which the economic drivers, like revenues, are particularly persistent, which is actually one of the stories that we were telling, but we never test. So thank you for that suggestion. I think that's
you
something.
Can tie with your first test about revenue elasticity. That would be
great. Yeah, super helpful. So when we compare variable leases to finance leases, we do find that variable leases are less predictable, but we argue in the paper that the kind of differences in root mean squared errors are not economically important, okay? So you may be kind of puzzled as to why we find this set of results. That is, how can you simultaneously have variable lease payments that are more sensitive to economic drivers like revenues, and yet remain as predictable and as persistent as at minimum operating lease payments? And I think Ayong already kind of provided the explanation. This can happen if you have a driver that's very persistent. So here's one way to illustrate this idea. This is kind of, this is equation 4 in our paper. Suppose variable lease payments is a deterministic function of some underlying driver X. The fact that we capture sensitivity, greater sensitivity to this driver, simply means that the slope coefficient, the psi, is bigger. It's greater than 0 and bigger than the sensitivity with respect to other lease payments. Okay, there's no problem with that. But these variable lease payments could still be very consistent as long as this X, the driver, is highly persistent. And so we think these results, in fact, could be quite rationalizable. And we also think that this explanation is consistent both with the FASB's initial views, as well as some of our own interviews with practitioners. The view that lessees and lessors, they're typically unwilling to enter into agreements that involve large and unpredictable changes in lease payments, and that they typically share some level of understanding about the likely amounts of payments. Okay, we can't test that explicitly, and that's one of the limitations, frankly, of our project, which is we would love to be able to have contract level data. We don't, and so we're making inferences using large sample and trying to triangulate based on other sources of qualitative information that we have. Okay, so what do these kind of first set of results tell us? At minimum, I think they raise some questions about one of the main assumptions underlying this new standard's differential treatment of variable leases. That is, that these lease payments are significantly more difficult to predict. Yes, Ken.
Yeah, just a short question. I mean, couldn't you look at subsamples where the financial viability of firms change over time very much? So, I mean, if you have a sample here with very solid firms and they are solid the whole time, and we're going back to the question that was before here, probably you get these results because there's not going to be much change. It's like predicting dividends. But the minute you start to look at firms that change their quality, the viability changes of the firms, then you would expect to see differences between fixed contract lease contracts and variable payment contracts.
Yep, I think that's very fair. We haven't dug deeply into the heterogeneity in some of these results. And per some of the prior comments, it's certainly quite possible that for some subset of companies, that differential variability could be significant. And that's probably something quite worthwhile for us to understand. Thank you for that. Okay. Now, given this treatment, the new standards treatment of variable leases, what we do next is try to better understand some of the consequences of this new lease standard. Okay, the first and most obvious one is to just examine what happens to leverage, and we see that leverage goes up by quite a bit. That's not a surprise. This is, if we didn't find this result, we should be worried. But given the economic significance of variable leases, now what we a natural concern might be whether or not the off-balance sheet treatment might lead some companies to kind of restructure operating leases and classify them as variable in order to avoid recognizing them as liabilities. Okay, in particular, they may do so to the extent that financial statement users do not account for these off-balance sheet liabilities. And these are concerns that were raised during the 2010 exposure draft. So we're going to try and examine to what extent these concerns are warranted. The first thing we'll look at is whether or not there's any evidence of lease restructuring. And the second is to examine whether or not market participants, equity holders, debt holders might respond to the presence of variable lease payments. So we're going to look at equity betas and credit ratings. We do find some evidence that's consistent with the idea that there could be restructuring of operating leases. Okay, this is a result that's, we're not the first one to document this. Wang's JE paper has documented this. There's another couple of papers that in Agnes's presentation, she cited Yoon 21 and Chatterjee 20. What we find is that after adopting the new standard, firms report significantly lower minimum operating lease commitments on average. And this pattern is particularly pronounced for those companies with a high ratio of minimum lease commitment to revenues in the pre-adoption period. So these strike us as being consistent with the idea that firms are responding to incentives to keep at least some amount of leases off balance sheet. Okay, we get similar results when we scale these minimum lease payments by revenues. Okay, now next question is, well, do users incorporate variable lease payments into their assessments of companies' risk? When we examine equity betas using very similar regression specifications, we find that while the adoption of the new standard increased betas very, modestly, once we control for book leverage, there's no evidence that betas are responding to the extent of variable leases, okay, as a proportion of operating lease expenses. And we find a similar result with credit ratings, that credit ratings are not responding to the relative magnitudes of variable lease payments. Okay, and this is again consistent with some of the conversations that we had with industry professionals. We had the opportunity to interview some of the folks who think about how to incorporate leases into Standard & Poor's credit ratings, and they confirm that variable leases is simply not part of their consideration currently. Okay, so no evidence that equity betas credit ratings reflect potential liabilities associated with variable leases. Now, the last question exercise that we do in this paper is to offer a methodology for users to estimate the present value of future variable lease payments. Okay, and our idea basically exploits this. We exploit this idea that variable lease expenses could be a useful anchor for variable lease payments. So if the ratio of variable lease expenses to operating lease expenses were something like a fixed constant, basically, then what you should expect to see is that the total liabilities associated with the two would also follow the same ratio. Yes, Ken?
I'm sorry, I'm a bit late here. Could you go back one slide?
Sure.
I mean, basically, I mean, there is a theory statement in information economics that being uninformed is the average of being informed. So, I mean, what you see here is that if you don't know some piece of information, you are on average, if the market is kind of rational, if participants are rational, you would on average guess the correct number in expectation on average. So if you get additional information, you wouldn't really expect the average values to change very much, but you would expect the variability in the numbers that are predicted to change. So you will be more informed about various firms, but not the average will not be affected. So, I mean, your results are consistent with rational kind of market participants, but it's not really for sure that they do not affect the decision makers' decision about equity betas and credit ratings. So have you thought about that?
We have not. I'm not sure I kind of fully distilled what you mentioned, but it seems like something very important for us to think about. What we show is when we control for book leverage, debt to equity ratio, that book leverage has a significant impact on equity betas pre and post, but that the incremental amount of leverage that's coming from variable leases do not have no impact. Would that be consistent with the theory that you espouse?
Yes, it would.
Okay. This is something we'll have to think a bit more about. Certainly important in validating our claims. So we may reach out to you later on to better understand this. Thank you for that. Okay. So what do we do? Okay. So basically what we do is we look at the ratios of variable to operating lease expenses, which we find to be highly persistent as well. And we propose a fairly conservative approach for how we can use that ratio to back out an estimate of variable lease liabilities, okay? And when we apply this method, what we get is that if you impound this number into your estimate of true liabilities, total debt would increase by about 8% for the average company, and we would add about $300 billion of debt among the Russell 3000 set of companies. Okay, and we also show that there's some variation in this impact. It's particularly large for companies in the transportation, consumer durables, retailing, food, and pharma industries, and smaller in others. Okay, let me just make a couple of comments about the current limitations we face and what we can or can't say about it. One of our main limitations, of course, is the rather limited sample that we have. We only have 3 years at most of post-adoption data for the sample. And so a natural question you might have is, how do your results, will your results hold going forward? We don't have a great answer to this question. And we hope this is an opportunity for future research. Another question you might have is, what can we say about the persistence and predictability of longer horizon variable lease payments? One thing we have done is to look at the persistence and predictability of 2-year ahead lease payments, and we show that our inferences are basically identical, which is that 2-year ahead predictability of variable lease payments and persistence very similar to those of operating and finance leases. And so another thing we can say is that to the extent the question about long horizon variable lease payments raises questions about the extent to which the kind of liability estimation could be reliable. We also perform an additional set of analyses to articulate the following point, which is that due to discounting, the accuracy of near-term forecasts is far more important than the accuracy of long horizon forecasts. Okay, so we do a bit of a simulation in the back end of the paper. We basically take operating leases, reported operating lease payments, minimum lease commitments. We back out the discount rates. We know their reported present values. But then what we do is a simulation exercise in which we artificially inject errors, okay, of different magnitudes across the horizons of minimum lease commitments. And what this simulation shows is not only that, yes, near-term measurement errors, forecast errors are far more important, but we can quantify how much more important that is. So one thing we found was that on average, a 10% error in your 1 year ahead forecast of lease costs has a greater impact on your present value estimate than a 50% forecast error for 10-year ahead. And the reason why we're doing this is to show, hopefully convince the reader why one should care, even though we only have results for the predictability and persistence of 1 and 2 year ahead lease payments. These are in fact the most important properties we should care about if the question is, can we estimate potential liabilities reliably? Okay. So we think that our paper contributes to the literature by being the first to examine the properties of variable lease payments and the consequences associated with keeping them off the balance sheet. We have a unique comprehensive data set on the detailed lease disclosures, variable lease disclosures, and we offer a method to estimate off-balance sheet variable lease liabilities. We think, hopefully, that these findings are relevant or are of interest not only to standard setters in their post-implementation review, but also to users of financial statements. So that's all I've got. Thank you all for your comments and suggestions.
Great, thank you so much, Charlie. Fantastic, and Agnes as well, both wonderful presentations. Thank you everyone for your attendance and participation. I'd like to mention the next ADP workshop will be on April 6th. It's Andrew Schmidt from North Carolina, NC State, from 11 to noon Eastern time. Again, April 6th will be the next one. Oh, there you have it. Perfect. Thank you very much, Charlie.
Yeah, thank you, everyone. I'm gonna stop recording.